What's going on, everybody? Always glad when people get interested in using Discord more. I'm telling you guys, it can improve your trading. And if you're new, it can improve you over 100%. And that's not even exaggerating. Such a useful tool. Well, I was hoping that Options Trader was going to jump into the stream because that would have been a good example to go over. Poor guy had a good bias for a long trade, but the options were just trash. And, it happens to all of us when we get it wrong, but it's worse when you get it right and you still lose because the options are bad. And that's just the way it is. So you got to get used to recognizing what good and bad options look like and then avoiding them. No matter how much we don't want to avoid them, we want to get the trade. You just got to let them go. So, anyways, we'll cover something else. I had a couple of requests, and then one that really is kind of old school, but I like it. It's an open range thing, but it looks at it from another point of view. It's really interesting. So, mean reversion, I really like this, and it's a trading style that when I was new to trading, I found really difficult. I didn't understand some of the nuanced pieces to it. But when it comes to mean reversion, there's some really neat tactics that we can do that bring math into the equation. And I know not a lot of people like math, but you don't have to do the math. You can just let the machine do the math, and then you just read the outcome. And that's kind of the best way to do it, right? We drive a car, and I'm not sitting there calculating how fast we're going. I just let the speedometer do all the work. And then I have an app that tells me how long it's going to take for me to get to where I'm going if I continue to go as fast as I am going. Yay, no math. So there is something out there called the Z score. And of course, you can go out and read a bunch of articles on what the Z score is, but it's basically checking how far away a particular price is from its average price. And that could be any number, your bowling score, how much you pay in groceries every month, whatever you want. We want to use it for stock prices or market prices and evaluate how far away we are from the average turning point of when a stock gets overbought or oversold. In the morning briefings, you guys see me do this all the time with a bastard version. I use the 10-week and the 10-day moving average and how far away we are from this. And I like it. This is the industry's standard, and it suits me. Every market has its own Z score. how far Tesla gets from its mean on average is going to be completely different than how far Apple gets from its mean on average. So we can't make some general assumption that says, well, when a market gets, 3% above or below the mean, it's going to reverse, because that don't work. Instead, we want to focus on first evaluating a particular market and having an idea about what that market's average turning point is, or what its Z score is. Thinkorswim, I could have swore over the years I found something in Thinkorswim that does the Z score, but it wasn't called Z score. And now I can't remember what it was. So I dug around in my workbook and I got my old Z score indicator out. It's not mine as in I calculated it or I built it. It's mine as in I found it over the years and I stuck it in there. Whatever code was in it to begin with is still there. I don't think I added anything to it. Yeah, no, I didn't. And so I can't give attribution to whoever made it because, well, I don't remember where I got it. The main thing is it's not mine. I didn't make it. So you can put an average on this. I've thought about doing it, kind of messing around with different things. Of course, you can expand it and make it more. And on TradingView, you don't have to do anything. They already have one. And I've got one over there that I'll point you guys to because, well, there's more than one. And it'd be easier if we just focus on the one that I'm using, unless you have one that you like better. So for this one, I'll just share it with you guys. This is the Thinkorswim version. And when we get to TradingView, I'll share that one with you guys. So for me, I turn this thing on, and what I'm focused on is where the extremes are on whatever product it is that I'm happening to look at. So let's use, drones were moving around pretty good today. So JOBY for an example, right? That that's the best thing for them is GTFO. Um, Oddly enough, well, not, I guess it wasn't odd, but fairly or unfairly, not all drones companies are treated equally. And the ones that did move were not really, at least in the pre market, they weren't the electric vehicle takeoff and landing kind of passenger service taxi type drones. It was more of the military and anti-drone software, um, anti-drone devices. Those were the ones that were really getting lit up. But we got JOBY here, and I've got the Z score on the bottom. Z score works on whatever time frame you're on. So if you want to use it on a 2 minute, fine, use it on a 2 minute. You use it wherever you want. I like it on the daily and the weekly, and we're looking for extremes. Now, an indicator doesn't know when to shut up, so it's just going to keep feeding you information all the time. Don't let that distract you from its value and what you're looking for. Right now, we're not at extremes. We can look back and see there was an extreme here and there was one here, right? And we're not there. So I'm done. I don't need to look at this anymore. JOBY, even with this phenomenal run that it's already had, is not overbought. Done. It's as simple as that. Now we can get, nuanced with it and try to calculate, is it speeding up? Is it slowing down? Are we getting higher and higher or farther and farther away from our Z score? Sure, yeah, whatever. You can always fiddle with the numbers. But if I see a company has made a big move, I can immediately pull up the Z score and check and see how far away from the mean it is. And if it's in an area where it has previously shown that it likes to reverse at. Done. If it's not, and you're looking for extremes, you can move on to something else. If we look at the weekly, for an example, there was two different turning points or two different highlights of where this went extreme, and it was far away from its mean, and both of those stopped cold. That was it. It was done. If we saw it getting back into that level again, hey, that would get my attention. Looking at it where it is right now, I don't care. This tells me, hey, we're not overbought. We can go higher from here. This does not owe me a mean reversion. Ta-da! Simple, sweet, easy. I like it. It's not complicated. Cheers. Right there you go. Now you've got a way to better identify if a market has run too far, too fast, and if it owes you some sort of mean reversion. Dun, da, da, da. I like it easy, right? So on TradingView, and this is what brought it up. I was shopping around in the new indicators section, as I tend to do during slow weeks, and we had a pretty slow sideways week. So I was shopping around and I had found a new Z-score indicator, and I thought, wow, I haven't seen Z-score indicators in a while. That's something we haven't talked about. And so I went and dug my old one up out of the Thinkorswim box, and here we are. So let me dig that one out. I know I got it around here somewhere. Maybe I left it on this one. I accidentally closed one of my panels today, and yep, that's the one. This is a really pretty little indicator when it comes to Z-score. I made an adjustment to it. I turned off the table that goes with it. It's okay. It's just that the table is on the right side. And of course, that's where price is, and that's where the indicator is. So then I was having to drag everything to the left, farther away from that box, and it became frustrating. So I got rid of the darn thing. Um, but it doesn't hurt to have it on. The table actually shows momentum as well. So, it's go to style and then turn the tables back on. And then I turned off the momentum background. So if we put it back in its original shape, it looks like that. That's the one on TradingView, and it's called Rolling Z-Score Trend by Quant Algo. It's free. You don't have to buy it. Don't buy indicators, for goodness sakes. And then of course you can change the colors and whatever. I like it the way it is. It's fine. I just want to turn the extra stuff off because I don't need it. And that way you have it on TradingView. Cool, 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 cool. You like it? It's pretty, isn't it nice? It's so vibrant, right? Like neon color. Makes me want to go to the bar. Oh my goodness. The wife would scalp me if I spent an entire week's paycheck at the bar. I used to do that maybe when I was younger, but nowadays, oh my goodness, my liver would probably scalp me if I tried that. I don't think I could hang with the kids nowadays. All right, so that was one bit. The next one is a topic that I have studied extensively, and it ties into the open range. I'm a big fan of the open range, and there's so many styles to this. There's a swing traders style to open range called the day one open range, DOOR, door for short. And of course, I found that in a very obscure old book long ago. But there's a lot of different open ranges. And when I first got into open ranges, I found articles that talked about a 1 hour open range. And I thought, well, that's okay, I suppose. But what if you're trading in a smaller time frame and you don't want to wait for the first hour to go by before you take trades? So then I started to focus on 30 minutes and then 15 minutes, 5 minutes. And at some point, I really like tick charts and I started to use those more. And then, of course, you don't have time now, right? You're not counting 5 minute bars or something. Instead, what I would use is the first swing high and the first swing low and use that as my open range. But however way you want to do it, it's been around for a long time and it's what a lot of people focus on. Well, over the years of working on the open range strategy, I had come across some material about the way institutions trade and that first hour of trading, which they generally consider to be the close. And just stick with me for a moment here. From 9:30 to 10:30, when we get all that volume on the day, a lot of institutions, they're done in that 1 hour. They may circle back in the last hour, power hour. They may. Otherwise, whatever they did today, they're done by 10:30 and that is the close for them. And if you mark that 10:30 close and look at it over the next 24 hours, watch how price reacts when it gets back to that 10:30 close, whether it's in the middle of the night in Globex, the same day that it was made, or right before the open the next day. Watch how price responds to that level. And it's called the true close. Now, whether you like the name or not, it is a pivot of value and it really has some value to it. Like it's a really good value. Yesterday's uh, true close was around 63.01 and it was what I used to get out of this trade to the short side that dropped us right down into this little pause here. I shot that line too long. It should have been like right in here. And it was 63.01. Close. Couple ticks off. I knew that's where the level was. We got down there and it hit like a brick wall and just stopped. Right. So all you got to do is just mark that level out. Um, Throughout yesterday's session, the true close was actually this doji here. So if I wanted to do another one and shoot that across into today's session, well, through today's Globex anyways, didn't really get a lot of response off of it. Last night we paused there. Not really a good example, but it just so happens to be the halfback of our Globex last night. Coincidence, more likely, right? That's just a given here or there. So, anyways, you can do this by hand every day. I went looking around. I know Thinkorswim doesn't have one, but I went looking around on TradingView, and I did find one that will draw it for you on TradingView, which is really nice because it's kind of a pain in the bum to have to draw it out every day, right? It's not a big deal, but what if you wanted to do, the European session and the Asian session and what a mess, right? So wouldn't it just be so much nicer if they do it for you? And on TradingView, they did. Right. You can make your own. I built mine into an open range indicator, so it just does it for me. But if you wanted to hunt for one on Thinkorswim, they don't have it, right? Mine is inside this. This yellow line right there is the quote true close line right there. So mine already has it built into it. But mine only marks it that way if you're using a 1 hour open range. If you take my same indicator and you set it to like a 5 minute open range, you will not get that yellow line where it's supposed to be. So if you're wanting to do it, with a different open range, you'd want to use a different indicator. And I'll share mine. Happy to share, no biggie. But you're just going to be stuck with my 1 hour open range. I don't think I was lucky enough to save the chart that had the indicator on it, which isn't a big deal. I know where it's at. We'll just go get it. But I was hopeful that I had, actually saved it. I stuck it in my favorites, so I know I'll be able to find it. See if right. I found it. True Close Institutional Trading Sessions. And it's by this guy by this guy, whatever. And he does have a nice little write up with it too, which I thought was cute. So if you want to find him, you could just search for True Close. You can see that was the name of the indicator. You could find it. Just turn that box off if it gets in your way, like it does me. I don't like it. I turn it off. And for the shading on the sessions, this really bright white area that's right on top of the trading session, I tried to make that um, gray out into a better gray so it's not so bright and in our face. That didn't work. So what I did is just chose a color change and that worked, right? Just gray it out by actually physically choosing a different color, not by changing the opacity of the box. That's a big word on a Friday. This one is really nice because it does do the Asian. Sydney's, I mean, that's a joke. You don't need to mark that one. But whatever. It has Tokyo, London, Sydney, and New York, and then it carries it forward. The guy who wrote it is not in the U.S., so his dates and times are all screwy. If you go in and try to mess with it, you'll break it. I know because it said that the New York session opens at 3:30 in the afternoon and closes at 9 o'clock at night or 10 o'clock at night. And I said, yeah, that ain't right. I went in to change it and it broke the whole thing. So just you can change the UTC at the top, but then you're going to have to change all of the times on all of them. And I don't know about you, but it just seems like a big pain in the bum. So I just leave it alone, right? Ain't broke, don't fix it. And then, of course, I turn the table off and life is better for me. So, True Close, guys, I'm telling you, this is it's a really awesome pivot that people sleep on. They just don't see this one, right? And I gotta say, I don't mark it every day. I usually keep track of it. I'll have it in my notes somewhere. But a lot of times it just doesn't come into play, right? We're either well above it and we're nowhere near it, or we're far below it and we're nowhere near it, and there's just no reason to mention it and just doesn't come into play. Today we're crossing back and forth through it relatively well, which is fine. But if we stay in that range, just going back and forth through it, it's not very useful or it doesn't have a lot of value. If we was to leave the range and then come back and try to challenge that true close, I think you'd see a much better response out of it. And if we were in Globex tonight, if it wasn't Friday, right? If this was like Thursday night, we get into Globex and sometime around 8 o'clock at night, we were to interact with it, we'd probably see a good response. Sunday night, we're going to open. I wouldn't look for it to be very valuable Sunday night, right? CrowdStrike and PANW getting some action. Not sure what's going on here, but they are taking a little bit of a sell off. I don't know. Did you guys break something? Who did it? I don't believe you. Oh, it's not that bad. I thought it was going to be much worse than that. It's not that bad. It's down a little bit, but that news is 4 hours old, so I doubt that it was that. So it's just an old concept, right? It's been around for a long time, and it's another take on that first 1 hour of trading volume, right? The open, which I really liked the change in perspective from focus on the open to actually, oh, we're just wrapping things up, right? It's the close instead. That it was a unique, concept, but it has proved useful over the years. I always like the RTH Open. That's another pivot that most people just completely ignore, and I don't. I love it. I pay attention to it all the time. So if you are marking out pivots or kind of keeping a list of pivots that have value, the RTH Open is another really good one. Open range on different trading sessions is not really something that I use too much because I don't want to get up at 2 in the morning and come in here and trade. But if you are in another nation and these hours suit you better, use open use the open range on any trading session, the European session, the Asian session, whatever, because it works, and it's really cool. You can use the 1 hour, mark out your levels, and all good from there. I mean, I know a lot of aliens, but I don't know any Martians. I do know a lot of aliens that trade, though. Yeah. Yeah, he's probably an ICE agent. I don't know. I like it. There has been a topic that we've covered before, but it's always a favorite, and it involves the idea of participating in a range. And I always like this one because it's just a point of view perspective, right? There's no wrong way to go when it comes to trading, but there's, what we like, what we don't like, and different tactics along the way. One thing that I've always come into when it comes to ranges is that I'd rather not, right? I'd rather find something else. So if I am looking at price and it happens to be, say, right in this situation, we're not at the low of that range, we're not at the high of that range, and we've already broken above the reversal bar and we've closed here. Is this a tradable opportunity? And of course, sure, everything's tradable. Would I do it? Probably not. There's not a lot of room between, 63.20 in the top or whatever number that happens to be. So this distance isn't much. And then we're in the middle of a range. We're not leaning on anything. And you can widen that range out, and have that same conversation. If we're sitting in the middle of a zone or in the middle of a range, what are we supposed to do with that trade? And are you willing to get in when we're in the middle of a range? I wish I could say I never do it, but that wouldn't be true, right? I do it, you do it. I'm sure we all do it. But should we do it? Or, what's your trade results been when you did do it? I haven't had a lot of really good success when I do it. Not to say that they're always losers, but even the winners, they're just generally not as good of a winner as, what I'd like to see. One, they are almost always capped by whatever top of the range is. And that's if we even get back to the top, or if I actually get it to close when we're at that top, right? Because that requires some skill on its own, just getting the darn thing to close where you wanted it to close. So I generally try to avoid those trades, and instead I focus more on the edges. And I know I get it all the time that people say, well, I've only got like 30 minutes, 45 minutes to trade during my lunch, and this is what we had today. And so this is what I was trading. Yeah, I get it. You didn't learn to trade just to sit around and not trade. But look at your trading results, right? If your losses are equal to the size of your wins and you're barely even hitting 50 or 60%, you're not going to make it that way, right? It's just unsustainable. You have to adjust something. So improve the quality of the trades so that you can get a longer duration trade or more profit out of it. Find a way to reduce the stop, which always sounds good, but you can't get too close or you're just going to get wicked out, right? There has to be some way to balance all the parts. So it's the same old trouble. A few weeks back, I had mentioned that your risk to reward is directly connected to your profit target, and so is your win rate, right? So look at how often you win, and then look at how much risk to reward you're trying to get. What you'll find is if you're aiming for a higher risk to reward, your average loss frequency is higher. So if you want to win more often, lower your risk to reward. But that has consequences, right? If we lower the risk to reward, then we need a higher win rate just to be able to sustain the trade or to stay green. Now we need more trades, so we need to increase the frequency of the trades that we're doing. It's just everything readjusts because you changed a number. And it won't stay at the perfect level, right? You might get it dialed in pretty good and then the market's going to change and you'll have to readjust one of those numbers. What I like to do is keep track of what my numbers are currently. So, what's my win rate right now? What was it last week, last month, last year? And then what was it today? And when I trade again on Monday, what was it on Monday? Is it staying steady? Is it getting better, getting worse? And that is a bit of a warning or a heads up that, hey, something is slipping. My risk to reward is changing. And then, of course, what's my win average? Is it increasing or decreasing? Those are the kind of things that I like to journal and keep track of. And a lot of the stuff that I do see people journal, you're not journaling, you're just recording your trade, right? And your broker will do that. If you're going to log your entry and your exit and how many contracts you used and where you got out and how much profit you made, you could just download that information straight from the broker, save yourself a lot of typing. You don't need to mark that down, they did it for you. Instead, if you're going to journal, try to put something down on paper or wherever you're putting it that when you look at it 9 months from now, it actually has something to teach you. I don't know about you, but looking at a bunch of spreadsheets that says I got in here and I got out there 6 months from now isn't going to tell me if I'm improving or not in my trading. Sure, your P&L will, right? If you are making more money every week than you made the previous week, you must be improving. But that's not technically true, right? All we have to do is increase our risk. That doesn't mean that we're doing something better. We may just be willing to take greater risks, and suddenly we've made more money. So the trade that I was hoping to review, I'm going to go ahead and do it, and the guy can just catch it on a replay. This I think is worth covering because if you trade options and you're new to options, you're very likely going to make this mistake that this person made and I have made, and every trader who ever traded options has made this mistake. So it's not like this one person, managed to find a screw up that none of us ever found. We've all done this. So if you're trading options, you want to find good options to trade. It sounds good. I mean, you would think it sounds easy. How hard could it be to find some decent options around here? It's a lot harder than you think. So, household names, Nike, Disney, John Deere, you would, probably at first glance believe that those household names probably have really good options. Why not, right? They're famous, well-known companies. They don't, but it doesn't hurt to make that assumption. So when you go to look at a stock's options and you're trying to evaluate if those options are any good or not, start with something really simple. Does it have weekly options? Most brokers will show weeklies. You may have to turn them on, but they'll show you weeklies. Somebody else need turned on? So once you get them turned on, just because it has weeklies does not necessarily mean that it's got good options, but it's a start. Because if it doesn't have good options or if it doesn't have weeklies, you already know the options are no good. You can just stop right there. To be fair, if you're selling options or you're going to do something a little more complicated, this isn't as much of a detriment. But if you're just, buying calls, buying puts, taking the stock for a run, you really need weekly options. Now, what you could do, you personally, with this is you could make another screen that references this one that you've already got named called Scan Big Movers. And what you would build your new one to say is where it says scan in weeklies, you would tell it scan in big movers, and then you would intersect that with whatever option stuff like say call sizzle or put sizzle. I would do each one of those individually. And that way, if it's in scan big movers and it has call sizzle, it'll trigger in your new watch list. Yes. Yes, you can. Yep. Yep. So sizzle is a really nice tactic if you guys are not using it because there's volatility sizzle, volume sizzle, call and put sizzle, and then stock sizzle. So, and stock is shares. So you can get volume from calls, puts, and shares, and then you can also get volatility ratio, kind of, all from sizzle, which is fantastic, right? And a PC ratio. You can get like a put call sizzle ratio, which is really good. So you can find things that are hot now, but that again doesn't mean that it's got, good options. It just means it's got hot options because everybody's piling into them. The sneaky thing is, though, if something has an average trading volume in calls of like 10 and somebody goes in and buys 50 calls today, the sizzle lights up and it says, oh, wow, this thing's getting lit up. Look at this. It's 5 times the average call volume. Yeah. Instead of 10, it had 50. Still trash. I still don't want it. So the sizzle's okay, but it's really handicapped, which is why I like to use it. against a watch list that I already have and not the basis of a new watch list all by itself. And this from Marziti, that's a really good um, watch list that has a lot of criteria pre-planned, really thought out, and set to parameters that he already likes, which is why it's perfect to use that one in an other scan and then bring in something like Sizzle. That way it's referencing something that you already made. It does, yeah. And you'll get some goofy results too, right? So what if you're new to what we're talking about, guys, on Thinkorswim, if I build a scan and then I reference that scan with another scan, and then I reference that scan with another scan, that's going 3, 4, 5, 6 layers deep. And it's all well and good until suddenly it isn't, right? Thinkorswim updates its servers like about every 3 to 5 minutes. And so it can get lost in the tumbleweeds, and it might take 15 or 20 minutes before that one down at the end finally gets its update. And you might get some results that you weren't interested in. But it is really handy to link your scans to another scan. I mean, that has really helpful stuff because the what I call it tier levels. You can really tier level your way down into something very specific. What I like about doing it that way is the process of elimination is my approach to building watch lists. I don't want more names. I want less names. It's always been my goal. Other traders have different goals. They want to find names. I want to eliminate names. To each their own, right? You nailed it perfect. When I was messing with Excel, I was trying to run a lot of these um, calculations in the columns from Excel. What a mess, right? And I finally gave up. I was like, that's a freaking nightmare. But if you already have the column on your scanner and then you import that column into your Excel or whatever you use, Google Sheets, you already have the number. So then now you're good, right? It just saves you from building the formula in the Excel. Just build it here, have it in your watch list, and when you download it, you have the number you were looking for. Fantastic. So we talked about weekly options, and that's a really good step. If you come in and you find that the thing that you want to trade has weeklies, now you're free to dig a little deeper. All right. The next thing that I like to look at is how expensive is the stock versus what is the strike width within the options chain. Now I'm looking at Nike. It's less than $100 and it has $1 wide strikes. I'm good with that. No problem. But if you bring in a stock and it's less than $100 and you go to look at the options chain and it's got, $2.50 wide or $5 wide, you're in trouble. Like you got some issues there. You might want to be careful because those really wide $5 wide strikes, they're going to get you hung up, right? They're going to have issues. And it's another sign of an illiquid market that you can find a company that's trading for less than $100 a share, and then it has $5 wide strikes, right? So if I go back to the example from earlier, it was TCOM. This is a $62 stock. There's no weekly options. And when we open up the options chain, they're $5 wide strikes. So that's a big red flag to me right there. No weeklies, $5 wide in the options chain. I knew what the problem was without digging any deeper just by seeing that. But we can still go deeper and we can look at, well, what kind of volume are we getting? None. Down at the bottom of the screen are the statistics for the options that are traded today. And in the entire trading day today, there was 172 contracts traded. The person in the chat, they traded two of those. So 107 of these, 170 was from others, two were from that trader. And that's all the calls, right? 128 calls, 44 puts, that's all the options traded right there. That is not a lot of options trades. Yes. Yeah, I tell you, I feel really bad. I have a coaching client who he came to me because he was already in a trade, and we've been working on trade since then. And I met up with him yesterday. I don't, he's not here, but um, he was in BBAI, and he bought the stock at around $4.15. He has like 10,000 shares, and he sold. No, he has 3,000 shares and he sold 10 contracts. Okay, right? 10 calls is what he sold. He got like 35 cents a contract. And when I met up with him yesterday, he said, "Hey, I went ahead and I bought those back at a loss. Why? What did you do?" So let's walk through this because I know others do this, and it took me a while to understand where his logic was, right? Like, why would you lock in a loss? Why did you do that to yourself? You forced an error and made yourself take a loss for absolutely no reason. I still have some of the writing on here. 415 is his entry. He had the 6.5 strike calls that he sold short for about 35 cents. All right. So I'm going to draw it out just like I drew it for him and try to rationalize why did you lock in a loss? Exactly. I didn't either. I was like, why would you do that? Why? Why would you ever lock in that loss? Right. So this is what he had: 650 calls that he sold short for 35 cents a piece. That's $350 in credit. And he got ran over when Trump announced something. And the announcement is what freaked him out. He's like, oh, this thing's going to go parabolic. it's going to end up at like 15 or $20. I better get out of these calls. Again, I don't understand his concern here, right? So I'm like, walk me through it. What's your fear here? He said, well, I thought I would have to buy the calls back at like $15. No, all you have to do is roll those calls up to $15, right? Like all you have to do is just keep rolling because at some point, exactly, you didn't have to do anything at all. I said you could just hands free, don't do a thing, and you're going to lose your stock at $6.50 a share. If you bought it at 4.5 and you sell it at 6.5, you made $2 a share, and you got 3,000 of them. Cheers, you made money. But here's what he told me, and this is why I thought it was worth bringing up. He said, "But my P&L in the account was showing that I was down thousands of dollars." And he's not wrong, right? If you're not on, say, Tasty Trades, which is 100% made for options traders, and you're on something like, say, Fidelity, where he was, his Fidelity was warning him in emails and when he logged into the platform, hey, you're down thousands of dollars. It freaked him out because, from the broker's point of view, if you sold it for 35 cents and you are short and you have to buy it back for $2, you are down, but you don't have to buy it back, right? Like you don't have to do anything. It'll handle itself. But that warning scared the hell out of him, and the stock was pushing higher, and he's new to trading options, and rather than, reaching out and asking me a couple questions, he just went ahead and exited the position for a loss that he never had to take. So when I asked him, what was your final thought here? He said, well, you said I shouldn't sell calls in a stock that's active. I should sell it in something that's underperforming. See, well, that's true. If you're going to sell covered calls, don't do it in an overactive stock because it's just going to run you over. It's not to say that you'll lose money. It's just that it'll chase you, and then you're going to cap your upside. You could have made more if you'd have never sold the calls at all. You'll have to, manage the trade in some way, but you won't lose money from doing it. You just won't make as much as you could have made if you'd have never sold calls on it at all. If it's active, let your stock do all the work. Don't sell a covered call on it. So that's why he bought him back. So if you're listening to this and you own stock and the stock is underperforming, sure, sell some calls on it. And if it runs you over, don't roll them for a debit by any means. If you want to roll them, make sure it's for a credit. And if you're concerned that you're going to do the roll inappropriately or doing it wrong, don't roll it at all. Just leave it where it is. Because the worst that's going to happen is that you'll lose your stock. But that's the wrong words. Because he told me, my client who's unfamiliar with options, I don't want to lose my stock. That's a loss I can't afford. Well, you're not losing it. They're going to pay you for the stock, right? They can't just take your stock. So if you sell a 650 call and you get exercised, they're going to take 100 shares from you and pay you $6.50 a share. Well, if you bought it at 450 and they pay you 650, ching ching, hey, you made $2 a share. So you didn't lose the stock, you sold the stock. Right. So I just wrote out a little cheat sheet on the screen. When you sell a call, it is your opportunity to sell your stock at whatever strike you sold. And if you buy a call, that's an opportunity for you to buy stock at whatever strike you bought. Now, I rarely ever take stock from calls that I bought. I mean, I can't even remember the last time I did it. I know I have, but I can't remember the last time. On the other hand, I have released stock that I own by selling calls. That one is pretty common. I do that one quite a bit. And the same thing the other way around with puts. I can't remember the last time that I bought puts to get rid of my stock, right? Like I just don't do it very often. But selling puts to buy stock, that one I do quite often. So they're more of the industry standard. Selling puts to acquire stock, selling calls to get rid of that stock, right? And that's the wheel when you think about it. You sell the puts, you get the stock, then you sell the calls and you get rid of the stock, and then you just do it again and you do it again, and it's a circle. So that's the formula. If you want to just, take a screenshot of that cheat sheet right there, that's the way you want to run it in your mind. That's the way you should see it. So if you're looking at something like Big Bear and you buy stock at $4 and sell calls at 6, and then it runs you the hell over, don't get scared. Your broker is going to say, "Oh wow, you're down thousands of dollars. You need to manage that call." Don't listen to them. They're not wrong per se. The call has swelled up in value. And if you wanted to close it, you would have to pay that value. The thing is, you don't want to close it. So just leave it alone. Don't worry about the new call price because until it closes, that's the only time you're going to need to worry about it in that last week of expiration. So just let it sit, let the value come back out of it. And if that value doesn't come back out, the worst that's going to happen is that they're going to exercise the call and take your stock and pay you a fair price for it. I say fair, but if the stock went to 20 and they pay you 6, you're going to be pretty salty about it, right? But you still made a profit. So, you know, worst case scenario, ask one of us. I met this guy because he was in another forum and he was asking about a trade that was very similar to this, and they had chased him up from the lows. He got into PLTR at like $20, and I seen him in an options forum somewhere around 100, maybe 110, and it had been chasing him all the way up from $20, and he was really upset. I was like, "Why are you upset, dude? You are in a fantastic trade." He's like, "Well, it keeps chasing me up. I can't get out." This is not a bad thing. This is like somebody complaining that they won the lottery. Right? What are you complaining about? You made the lottery. But he had rolled every time for a debit. So he accumulated loss all the way up because his broker sent him emails and told him, "Hey, you're really upside down here. This trade is, showing a big loss. You need to do something with these calls." And he rolled them and rolled them and rolled them and rolled them each time for a debit, just wiping out all the profit and putting himself in the hole. His account year to date is down over $25,000, and he had Palantir and Big Bear with stock at very low prices and calls sold at high strikes. An impossible situation to be down. So weekly options and then strike with two pieces of liquidity that we can tell at a glance if a company has got even remotely decent options to trade. And sure, like we mentioned, if you're going to sell them or do something complex with them, then liquidity is not as bad, but we can make some concessions. But if we look at this one, TCOM, we can see what bag holders look like. And I always love pointing this out because I have people that ask, "How did you know they're bag holders? Like what's your tell here?" And it's a pretty easy thing to spot. So just grab a screenshot here and we'll just focus on the calls. These options are going to expire in 7 days and we have a lot of bag holders. So to show where those bag holders are and what they look like, it's all of these strikes down here. We can see the ones that are being traded, even though it's just a few trades today. Those trades right there, and it's the strike at the money. So the 60 strikes getting traded. It has a $15 wide bid ask spread, has open interest of 2,600 contracts. And look at the mark. The mark is somewhere in the middle of those two numbers. Okay. Everything below that strike has zero on it. Nobody's hitting the bid at all. The other side of the first one is 30, everything else is 5, and then it jumps to 75. These are people praying that someone comes along and buys one of these calls from them. They've got a lot to get rid of, right? 1,600, 950, 550. They're holding losing calls. And if they can get anything for them at all, they're going to be happy because right now they are worth zero. They're worth nothing. So when you go in and you're thinking, this stock is making a run. I think I'm going to trade this to the upside. I'm going to go buy me some calls. If this is what you see, just stop right here. You can't make any money on this. If you buy it on the ask for $30, you will immediately be down 50% in your position because it's trading at 15 cents and nobody's even bidding 15 cents for it. So it's trading for 15 cents, but you won't fill on that if you try to get rid of it yourself once you buy it at 30 and you decide, "Oh crap, I actually don't want this." You can try to get rid of it too, and when you do, you'll see your number show up on the bid. Then you get to do what we were just talking about. "Hey, there's me. I put my order in and I showed it. I seen it show up in the chain. There I am." You'll get to see your own bid price. But you're going to automatically be in a losing trade right there. And the bad thing is if you look farther out here, these 35, 37 cent mid price, they're not worth that. If the ones above it are only worth 2 pennies, you know those are not worth 35 pennies. But the machine doesn't know that. And so if you actually was holding one of these trash options from way out here, you might be looking at your value on the trade and saying, "Well, it says it's worth 37 cents. Maybe I should hold on. It has a week left." It's not worth 37 cents. It's trash. You're just one of these bag holders, hoping and praying that somebody comes along and buys it from you. So we can tell that this is illiquid trash that we want to avoid. This NA that we see here, it's not an error telling me that I don't have data. It's a fact that I don't have any volume. Nobody has traded these strikes today. The only ones that got traded are right up here in the front. These are really bad. So when we see that, we just automatically recognize that I can't go long in this stock with these options. I'm going to have to do something else. A lot of times you can get away with going in the money. Sure, you may have to pay, $1,800, but you'll get a call that actually has some value to it. Unfortunately, even this one is so bad, you don't want to do that either. Another tip that we can see is on the put side, the strikes start to narrow up a little bit. It goes from $5 wide to $3 wide, and then to 2, and then to 3, and then to 2, and then 3, and then 2. These are warning signs, right? And look at all of those bag holders. Look at all that trash there. These are people that are just trapped in a trade and they've got all these different strikes and they're trying to get out of them. and they're almost out, right? These are really close to strikes that are going to disappear soon. Like that 33 strike, it's going to be gone soon, and then there'll just be a 30-35, and the 37 is going to be gone soon, and then it'll be 35 to 40, right? They're weeding them out, cutting them down. So when you see this, you automatically know this is really bad. This is trash. I want to avoid it. $5 wide strikes on a company less than $100, no trade activity, no volume, really wide bid ask spread, bunch of bag holders. All of those are signals that say these are really, really bad options. And if I try to trade them, I'm just going to get hurt. So we know to leave it alone and move on to something else. There is a thing called penny increment options. And this one's kind of subtle. I didn't learn about this one right away. So I try to mention it frequently so that new traders get to hear it nice and early. Penny increment options. It is exactly what it sounds like. The options price moves 1 penny at a time, as opposed to something like TCOM, whose options price moves in increments of a nickel. So it moves 5 cents and then another 5 cents and then another 5 cents. And that means if you slip, you're going to slip at least $4 to get into a position or to get out of a position. At the very minimum, you're slipping that much. You can't get anything less than that. There is a watch list of just pennies. So if you're sitting there thinking, well, how am I supposed to know which ones are pennies and which ones are not? One, you can look at the options chain. Does it show penny prices? I got Apple here, and we can see 16s and 33s and 86s. So it trades in penny sizes. But we also have a watch list. Thinkorswim built it. You just go into where it says public. They're alphabetized. So you go to the P's, and there's penny increment options. Every name in that list is a penny increment traded option. So when I build my scan, I used to only search weeklies. Then I started using the intersection with penny increment options. But I think another way to go would be to use penny increment in the front. We don't really even need the designation of weekly. And then on the intersection with, use the 24-hour like Marziti is using and run it that way, right? You have 340 penny increment options companies or ETFs or products that you could trade. But if we cut it with 24-hour trading, now we've only got 238. So it's a tighter list and it's 24-hour trading. And it gets us closer to our goal of finding liquid things to trade. So if I wanted to find moving average breakouts or moving average crossovers, I would first run it this way, penny increments, 24-hour trading, and then start putting in a filter for things like a moving average cross or something like that, right? Because now I know that whatever I find is going to, at the bare minimum, have penny increments, 24-hour trading, and it's likely to have weekly options. It earns this designation of 24 because it's liquid ish. Exactly. Yep. And that was my final conclusion. But at first, I just kept weeklies and added the penny part. And after a while, I got to thinking, I'm like, I'm wasting one of my two increment slots. Like I can remove one, just use pennies, and then use the intersect for something else. And you gave me the idea of using 24. So I like it. What I usually do is instead of putting 24 there, I intersect it with a particular watch list, right? I'll bring my drones in or my home builders, medical companies, whatever. And I run it that way, right? I leave the other spot open to connect it to a particular list that I'm looking at. But I like this. This is the broad approach 24-hour trading, penny increment options, 238 names. Works for me. That's a good reduction right there. And are, are we still going to find illiquid stuff? Yes. we will. Because, even though it's a household name like BABA or Bank of America, I bet we could go in there and still find things that are just not liquid, right? Like it happens. So you still have to know what trash looks like. You can't filter it away and hope that you never come across it. You have to be willing to go in and find it and know what it looks like. So I'm gonna make one small adjustment to this. The my scan capped out at 50 names, even though there was more than that. There was like 200 and something names. So I'm gonna reload the scan, run it. Wow, the list just went down. Oh, it's because of that moving average part. Let's turn that back off. There we go. And instead of it capping out, I'm going to let it show me all of these names. That's all 300 names now. That way it doesn't cap out. And I did that because I want to use this as my first tier in another scan. So this is just my broad outline scan. So I'll save it, make sure it's saved with the right settings. And then we will eliminate it or reset everything. And now we can scan in that scan. And we can intersect it with whatever we want, right? Like NASDAQ 100 or nuclear stocks, my momentum trades, like upside momentum, uh, my Heiken Ashi scan that we were looking at earlier this week. I suppose we could run it through that. Bullish Haramnis, a 20, 50, 200 daily. Yeah, let's run that. That looks good. 55 names. Nice. Let's load that up in the watch list and take a look at some of these. Maybe we'll find something good. And it will only have 50 out of the 55. I didn't tell it to load all 55. I capped it out. And that's because right now it's only 55, but next week it could be 500 or something, and it would really blow out the watch list. So I've got them sorted. We could like look at the ones that are in a rally or has upside momentum or in a pullback or a downtrend because I've got that. Or we'll just check the impulse. That works for me. We'll see which ones are getting that. Tighten everything up here. Federal housing statement from chairman of the board, Fannie Mae, Freddie Mac. Wait, I didn't catch it all. There was a housing alert. So we got Abby. It's in the middle of the range. It's kind of like what we were talking about earlier. Even though this isn't a day trade, it's still in the middle of a range. Was it big news? Oh, wow. they started going after him with talk about criminal charges, negligence, and all sorts of stuff. And I mean, they didn't come out and say that he's a pedophile, but they damn near called him everything else under the sun, right? Like they've been hitting him up hard in the House and the Senate and talking about filing charges against him. And I mean, geez, what do you expect the guy to do? And they're completely tarnishing his entire career. I feel bad for the guy. There was a question in the questions tab. Um, I'm gonna answer him in the stream here because I know I can't talk about all of it. So the question was about a broker. This person recognizes that here at the Bullish Bears we use a lot of different platforms, and that's because we are a lot of different traders, right? We're a diverse trading community. We're not all just doing one thing. So he sees all these different brokers, kind of gets overwhelmed, and says, "I don't want to have to learn three, four, five different brokers. What should I pick?" And really, it's a fair question, but it's missing the point. For an example, I show Thinkorswim in nearly every picture that I send and in all live streams. And it's because it is my analysis platform. I do most of my work here, but I don't trade here. I can't remember the last time I put on a trade on Thinkorswim. This universal tool allows me to evaluate stocks, options, futures, FX markets, and no matter what I want to trade, I can evaluate that product on this platform. So I love it. And it was worth learning, even though I don't trade here. And it doesn't cost me anything to have it. If you want TradingView rather than Thinkorswim and you want to pay for TradingView, then do that. You don't have to uh, take trades on TradingView, right? You can just use it for analysis and you can do all your work there and then trade wherever it is that you want to trade. When it comes to picking a broker to actually put the trade on, now where you live becomes important. I'm in the US. I can have whatever broker I want, and that is really awesome. If you don't live in the US, you don't have that freedom and that luxury. You very likely are going to be stuck with one, maybe two brokers, and that's it. Good luck, right? And you don't, that's just the way it is. So if you're in the US, go shopping, take a look around. The ones that you see us use can be broken into two categories, and they mentioned futures, and that's what I want to bring up when it comes to the two categories. There are two brokers that have a fixed margin rate set by the government, and those that have a very low margin rate that doesn't fluctuate with the government's formula. Thinkorswim, IBKR, Fidelity, Schwab, they all have that government formula and they require a very large margin to trade. Now, because of that, you don't have to buy data. The data is free. You can paper trade all you want and it won't hurt you at all. And you don't have to pay for data, and it's awesome. But if you're actually going to put trades on and you got to pay commissions, those brokers that I was just talking about that are giving you the free data, they're going to charge you a higher commission. That's their catch 22. You get free data, but you pay a higher commission for the trade. And you need to have a big account to be able to afford their high margin cost. On Thinkorswim, if I want to trade the ES, the margin is going to be 25%. No, excuse me, because this is now owned by Schwab. It's going to be 50% or just straight up 100% of the day margin. So there you go. You need $25,500 per contract to trade the ES on Schwab. Now, if you're hearing that and you're thinking, why would I want to do that when I can cover the same trade for $500 margin at Tradeovate? Now you know why we're using Tradeovate. It's not because Tradeovate's some awesome platform that has really great tools. They just have a $550 margin for the ES, and we say, thank you, right? And we go trade there. So when you open up the drop down menu, you have a bunch of choices across the top. Choose futures. Oh, there's some really good stuff hidden in there. The indicators is all of your your market breadth stuff. That way you don't have to go searching for it through watch lists or whatever. It's just right there. And oh, it's so nice, right? Just to have it all built right in there. And you got Fred if you want it, like your government Fred data, you can run lookup. Oh, it's so nice. And all your recents too. Yeah. Yeah, it's handy. So when it comes to brokers, the two groups are broken down into what I call boutique brokers and legacy brokers. The boutique brokers, like Tradeovate, have a low fixed rate margin of like $550 per contract, and you have to buy the data, but you have a lower commission. And that's what most of us use. They're not awesome brokers, they just have a low margin requirement. I do a lot of futures trading at Tasty when it comes to things like oil and gold and copper because Tasty doesn't charge me for data, right? But I have to pay the higher commissions. But the data that I would have to buy is expensive and I don't trade those products every day, so I just do it that way. But for the ES, the Nasdaq, that data is really not that expensive. So you buy it from Tradeovate or Ninja, you pay $16 a month or whatever, and you're good. You pay that once a month, you got lower commissions. So you just have to find the one that works for you. And there is no best, there is no, you know, right one. There's just what is right for you, what's going to suit your needs. Can you afford to use a high margin account broker? Because if you can, they're going to offer really good services, right? Yeah, absolutely. So, um, his takeaway was that probably TradingView and Tradevate would be the best combo. And I would say, yeah, if you don't ever really plan on doing stocks and options, it's not a bad way to go. You could replace TradingView with Thinkorswim and it would be free after you get the account open, right? To open Thinkorswim, you put 500 or $1,000 in it to make sure you get live data. And after a month or two, just pull your money out and you'll still keep the live data. And then you have your cash and you're good and you don't have to pay for anything. So you could do that and not have to spend the monthly or yearly requirements to pay for TradingView. But a lot of people that I know use their TradingView account to trade their Tradebate broker, right? I do. I trade my Tradebate on TradingView all the time, but there's hiccups. It's not it's not seamless by any means, and there's some issues from time to time. But yeah, you could run the combo any way you want. Tradebate or Ninja is the most popular in the group, but you got Optimus, Infinity, Ninja Trader, and you have those for a reason. Like some people, want the built-in book map that Optimus has. Some people are in Canada and have to use Ninja. Like you just yeah, you have to use what you got. So that's the takeaway. That scan list that I ran, it's not bad. It's bringing up reasonably decent trends. Um, I did want to highlight, we talk about thematics a lot, right? And by the way, Dollar Tree and Dollar Store and Dollar General, there was a sale there, right? And look at that stock move since the last earnings when they announced they were going to get that sale done. And then of course they did finally get the sale and now we're expanding even higher. They say if yes, sir, if 80 then 100, right? We did that. We stalled out. Now we're above 100. And if 100, then 200. It'll be in time, right? I'm not talking about, even by the end of the year, but this stock, keep your eye on DLTR, guys, because things are changing finally, finally. But when it comes to thematics, I got one for you guys that it's not a new one. It's been around for a while, but if it's not on your radar, it should be. And it is a medical group. It's medical reporting companies, and that's not exactly 100% what we would call this group, but it'll fit, right? So some of these are not they're just in there for other reasons. But look at something like Cardinal Health, CAH. Take a look at that bad boy. It is a beast, right? And on the monthly, it went from $60 to $170 since 2022 in September. It just kept right on going, right? There's Cardinal McCormick is another one from 325 to 725. Big pullback for sure back in late 2024. We had that huge dip, but it recovered out of that with an awesome cup and handle on the weekly, and it just kept right on going. This space has a lot to offer, and it's not done yet. And AI is really helping these guys out, right? Medical is crazy complicated, and when you're doing reporting and collecting from clients and doing billing, AI is really helping them out, and it's going to get better. That's one of the things that one of the reasons why you want to watch this space. I call them hedge fund hotels because they'll get in them and just ride them forever. Like UNH was until it wasn't. And you can see what happened when they get out, right? Because when they got out of UNH, it just fell apart like a popped balloon. Boston Scientific is another one that had a really nice run up from $50 to $100. It's stalled out now at 100, and it very easily could go back to like 75, right? I wouldn't be surprised at all if this thing takes one heck of a haircut and loses 50% of that gain. But I'll be buying it down there. I like Boston. Um, I like Cardinal Health, McCormick, and some of these others. I'm kind of shopping around like ISRG, Oracle, Novo, right, for their own reasons. There's other medical stuff going on here besides the reporting ones that I was talking about. But when it comes to those companies that are integrating AI into their billing, into the way that they share data, one of the things that I was talking about with my own doctor is how the hospital changed their medical system around. And I was like, what are you talking about? You guys just did that like 5 years ago. She's like, oh, yeah, now we have to do it again. They had all new tablets, all new system. It didn't speak to another system. It wouldn't speak to the city. There's all these roadblocks so that they can't speak to each other. And it's just a huge nightmare. Well, all of that tanglement is getting untangled. And sure, it's going to take time. And the current administration certainly ain't helping anything. But we have the aging population piling in, and we have AI helping to clean up the space to where things integrate and talk to each other better, and they can share data, get billing practices better organized. Make sure you always look at any bill you get from medical services because they screw up a lot. And there's no reason for you to be paying, some crazy fees for something that you didn't even get as a service. Oh, yeah. Yeah, the government only gets mad when you get more pieces of the pie than they get. They know you're milking it, but they get a piece of the milk, so they don't care. But if you can milk it in a way where they're not getting a piece of it, then they care. So on that options talk that we were doing earlier, we covered a couple of pieces of it already, right? We've got weeklies, that's one sign. We've got the strike width, that's another sign. How many strikes we see is another one. I've got NVO up here and I have a set number, but if I show all, that we'll see that there's even more. Now the bag holders are showing up way down there. I had it limited, so we weren't seeing them all. There's what columns you have. You can add columns depending on what broker you use. It wouldn't hurt to turn on a column for open interest and volume so that you can see the activity of the options that you're thinking about trading. There was a question about sharing the watch list. It's a two-tiered watch list. So let me share the first one first, and then I'll share the second one second. The first one is this one. Let's see, 2025 general scan. It's that one right there. So we need to load that one and then share it. Make sure it's doing what it's supposed to. Yep. So general scan means that I didn't sort it by any cost or sector or industry. My only requirement was that it had penny increments and 24-hour trading. You'll want to use that for your broad outline and then, correlate from there. The next tier that I made was I loaded that and I made another scan based off of that one that was looking at trends. Now that intersected with another watch list that I have that's using the 20, the 50, and the 200-day moving average. So let's load that one so that you know what it is, and then I'll share it with you. So I got to find it. They're all alphabetized. It is this one. So a guy named Corey, he's wrote a lot of books. His name is Corey Rosenblum. He looks like a kid if you see the jacket on his book, but he's an older man. He just looks young. He ages really well. He came up with this scan probably 5 years ago, 7 years ago. I really like it. It's generic. It's basic. It works. The criteria is this one, right? I don't really care about these other two, the volume and the stock price. They're not required. It's this piece right here. This is the piece you really want. The close is greater than the 20. The 20 is greater than the 50, and the 50 is greater than the 200. And what that does is first you have price. What's up with my drawing tool? Orderly, you quitter. Darn thing just quit on me for some reason. All right, so first you have price. It's doing its thing. Then it has to be above a 20. The 20 has to be above the 50, and the 50 has to be above the 200. And it'll find stocks that have that sort of organization to it. And anything that has that sort of organization is considered to be in a trend. Of course, we all know it can be above the 20, and yet it could be like bouncing on the 20, right? And really struggling and whatever. So, just because you find it in that list doesn't mean it's an awesome thing, right? Just a little bit of DD. But that's what his trend scan is searching for. So I intersected the first scan with this scan, and by the way, it's limited to the S&P 500. We could eliminate that and just scan for all stocks, or we could point it towards the Nasdaq or the NYSE, which one of those we want, right? I'm going to point his scan towards penny increment options just so that we don't limit it to only S&P 500 type things. And I'm going to save it, which should update the other scan. Now that I've saved it, I'll share that one with you. Now, once you have those two scans, you're going to make this third one. And the reason I'm sharing it with you this way is because I'm not 100% sure if I shared the final scan with you, if it would work for you if you didn't already have the first two scans, right? I could have tried, but I kind of had this sneaky suspicion that it would fail. So that's why I sent you those first. And if you look at what, that's right. Yeah. Nice. That's a good way to run it. So after you have those two scans, you'll set it up like this. The first one scans the general scan. You intersect that with Corey's rising trend. And then mine has these three boxes, but I'm not using them. Once you have those two, you're good. And you can just hit scan and then name it something, right? So here's the third one. I have mine named just trend scan, but you could name it, whatever you like. So I'll share that one with you. And since we built it this way in the stream, you can always go back and watch the replay and maybe go through these steps at a slower pace. And really, the when I first learned all of this scanning stuff and how you could stack them all together, it was like the possibilities are endless, and you almost feel, like you're overwhelmed by all the choices, all the different ways that you could tweak the settings. It's what it feels like at first. But when you really think it through and you realize that there are so many restrictions on what this thing can handle, just like we mentioned, if you stack too many things, it just won't work. I can run a very simple scan that focuses on an acceleration band, which is basically like a Bollinger band, but it's a little wider. And it's a very simple scan. You would think it would work. Oh no, it finds all sorts of things that are nowhere near that band and it screws it up, right? Like, don't think that you can give this all these scan parameters and it's going to do an excellent job and give you only what you want and eliminate everything you don't, because that's not the way it works, right? It's going to give you a bunch of stuff you didn't expect, and it's going to give you names that meet none of your criteria at all. It's just going to put it in there for some odd reason. Like, there it is. Maybe they want you to, buy Baba because Baba seems to show up in every scan, whether it meets my criteria or not. Who knows? So don't trust the outcome when you get it, right? Really look at it deeply and check the names against one of the parameters at a time to make sure that, yes, it's doing what it's supposed to do and showing you the things you're looking for. But now that you have that general scan, you can treat it as your benchmark, right? Like, take the general one because that's the broad outline scan. You use that one for your complete and total watch list. It's 238 names. Now, I know people who tell me, I don't want that sort of restriction. I want the availability of, you know, 7,000 stocks out there and I want a chance to trade them all. Hey, good for you. I don't. Right. So I don't want to look at 5,000 names, especially if they're not liquid and they don't meet my criteria. So this is a little tight, and it possibly is missing something that you would have traded if it had showed up on your list. It's possible. But for me, it's a sacrifice worth taking. I'm okay missing the occasional thing that I look at it later and say, "Oh shoot, that was a great move. Wish I'd have seen that." Yeah, I wish I'd have seen it, but I'll be okay. I don't need it, right? So just be mindful when you build a list using a process of elimination. It will do its job and it will inevitably eliminate something that you wish you'd have had. But I consider it a fair sacrifice. Now that you have that list, you can eliminate names on the list that are perhaps something that you won't trade. Maybe it's too expensive. Maybe you already have stock in the company, or maybe you're an activist investor and you don't like the company. Whatever. If you don't like it, once you make it, turn it into a watch list, because right now it's a scan. The names will change. Turn it into an actual watch list and eliminate names from the list that you don't want. I see John Deere on here. I guarantee you I don't want to trade John Deere. So if I turned this into a watch list, that would be one of the first names I would take off the board. It has horrible options. It is a disgusting stock, crazy expensive, really poor. I don't want anything to do with it. I'd rather trade Caterpillar, which, to be fair, it doesn't have much better options. But I don't know. I like Caterpillar better than I like John Deere. You got Lowe's versus Home Depot, right? Hey, what's going on? What's up with you? Oh, always good. Any day I wake up is a good day. Yeah, let's start with a few pieces of the butterfly in general. It's got three legs, right? So I'm going to use um, 15 as the body, and we'll use 13 and 17 for the wings. So when we say sell the body, buy the wings, we want to focus on the body being the midpoint, and the midpoint should be equal to the expected move length. So if I brought up the weekly expected move, it would be $8 higher than the close and $8 lower than the close. I would go out of the money 8 points, and that's what I would sell. And then for the body or for the width, it's whatever your risk is. Do you want to do $1, $2, $5, whatever, and you build your butterfly. Don't do the whole width of the weekly range. Do half the range because you're only going half the distance, right? You're doing a call side or a put side. Yeah, no, you can make the wings whatever size you want the wings to be, equal to the amount of risk you're willing to take. So here's next week's SPY range, the weekly expected move for next week. And we can see 633 on the upside. So you would go to the call side and you would sell the 632 and a half because you, well, I guess you could sell 633 if there is one. And then you would go, if you want, you would go to the put side and you would sell the 615 because that it's 614.90. So, round up 615. You would sell the 615 put and you would buy whatever puts you would want on the other side at whatever distance. $1, $5, $20, however wide you want to go. The width is on you. The location of the body is on where are these lines at. That's the butterfly play. You're cutting in and out. Right. Yeah, the percent number is the volatility. The dollar number is the expected move. Correct. Yep, that is absolutely correct. So right now, SPY's expected move for next Friday is $8.91. We would round that to $9, and we'd say next week's expected move is $9. And we'd look at where we are coming into the close. We're basically at 624. We'll round up 624. Take $9 farther out of the money from 624, and we get 633. That's where you would want to build your call butterfly. And then you just make it as wide as you want. Yeah, a lot of people did dollar wide because it's the cheapest you could go. But if you use something like XLF, it has 50-cent wide strikes. You can go even cheaper on something like this, but you got liquidity issues too, you know? Yep, this ought to clean it up for you. And one, it'll make it easier to fill. Two, you should be able to get a much fairer price for it and manage it better, get some profits out of it. Yes, sir. Yep, and that's a wrap, everybody. As always, if you guys got questions or topics that you want to cover, by all means, hit me up. I love doing it. I think that we got all the education on the website, but things have changed, and we're constantly getting new traders who haven't made it to that particular area yet, or there's just bits and pieces missing, or you just want clarity. Bring it up in the chat. We'll turn it into an afternoon session, cover it in detail, get your questions answered. And there's so many new things that we never talked about in those videos, like dealer gamma hedging and calls and put walls and just all sorts of stuff. So, you know, you got a topic you want to hit on, an indicator you want to review, a trading strategy. I don't care. Anything you want to cover, I'm down for it. And if y'all don't have any questions, I'd say let's wrap it up and get this weekend started. I might have a chance to get the bike out. That doesn't sound very fair at all. You need to get a bike. Get a sidecar. Those spiders have reverse built into them. How cool is that? To be fair, it is a whiny little like weed eater mower that runs the reverse, but still, you know, I heard somebody pull up in a spider at the gas station, and I waited for them to leave because I wanted to see it reverse. And the noise it made was like they literally fired up a weed eater, and that thing cried when he put it in reverse and backed it up. But it did get the job done, and it was a steep slope into the parking spot, and it got him out of there. 2025 bikes have it now. Vulcans, BMWs, Harleys, they have reverse. I haven't used it. I don't even know what it looks like, but I've heard they have reverse. When I was talking to the guy at the dealership, what he said he saw is that they were standing beside the bike and running reverse as they walked it back. I don't know. I haven't had a chance to mess with it myself, but it's called dual clutch transmission and has reverse in it and DTC. And they got automatic motorcycles nowadays, which I just giggle over, but whatever. I know I miss my standard truck. Yep, everybody, enjoy your weekend. We'll see you next week.